dirty little secret of venture debt, the dance that is played is we don't want to be last money in as a lender. Yeah. And we're the last money in, and there's no funding around. And that's when we get into trouble because it's important. It is debt. This is not equity.
Welcome, everybody. Thanks for joining us on Startup Equity Matters podcast today. I'm really pleased to have two amazing guests with us today to explore the topic of venture debt. And, we spend a lot of time exploring the equity side of startup funding, but equity is just one tool in the toolkit. And there's a lot of other ways that you're looking to source funding for your growth of your startup. And today we want to actually dive into venture debt, which is very topical and a great tool to be aware of, particularly as you're getting into that sort of Series A and beyond stages. I couldn't be happier to have two absolute industry experts around these topics and around startup funding in general. Jim Marshall. Jim has 20 years plus experience in the startup ecosystem in Silicon Valley. He's currently head of technology investor coverage at HSBC and has had an extensive experience with Silicon Valley Bank in the past. In this role, Jim delivers full platform for investors across the startup ecosystem in the US. And he's also got experience on the investor side. So he's co-founder and general partner of an early stage venture fund called Shelby Ventures as well. So Jim, thanks very much for joining us. And if you've got a little bit to add about, what your role at HSBC and how you're leaning into the startup ecosystem.
Yeah, thanks, Colin. It's great to be here. We started this business at HSBC about almost 3 years ago, exactly, kind of right after the banking. And the goal was to deliver that kind of that great sector client service, sector expertise, venture DNA, but do that on a large global platform, which is safe and secure. So HSBC is kind of the seventh largest bank in the world with $3 trillion in assets. So we deliver that small bank feel, but on the big bank platform. And we're working with startups and VCs, startups from pre-seed all the way through IPO, and VCs from emerging funds who are raising their first fund all the way to the large platform firms. So again, great to be here. Thanks.
Thanks, Jim. And certainly we've understand that whole element around needing that support across different countries. Our journey started in APAC, and then we've actually flipped up to the US. Our headco's a Delaware C Corp, and we've raised funding in the US. And you need good quality partners that actually can support you on both sides of the Pacific in our case, but globally. So it's great to see what HSBC have done in the innovation space over the last couple of years. It's excellent. And Scott, thanks for joining us as well. Scott is the FP&A practice lead and fractional CFO at TiVo Partners. Works directly with founders, bringing clarity to numbers so they can make faster and more confident decisions around fundraising, hiring, and growth. As I said, Scott has been in the founder startup corner for most of his time, but has really extensive experience across helping startups from pre-seed right through to Series D, helping with a lot of fundraising, raised over $1 billion, worked on over $1 billion in fundraising. And before at TiVo, you're head of finance at Lime. Welcome, Scott. I really appreciate, and I'm excited to hear your insights today. Do you want anything you want to add about TiVo and just how you're supporting founders?
Yeah, thank you, Cal. Appreciate being here and having Jim and I get to weigh in on this topic of venture debt. At TiVo Partners, we work with early stage companies, we say from Series Seed to Series C. I would say C+. It all just depends on how our clients are growing. We're fractional, full stack fractional accounting and finance team. So fractional CFOs down to accountants. And we leverage our team through collaboration. So when you might have an engagement with a founder with an accountant, accounting manager, and a CFO, but you have the entire firm at our fingertips. We've got over 170 consultants currently, over 400 clients that we actively work with. And really, we love to be with the founders. We love the startup ecosystem, and we love taking them through their journey and hopefully to a successful exit.
I'd like to kick things off just with a bit of an overview of what venture debt is. So maybe throw to you, Jim, just to give us a brief overview of how founders should be thinking about venture debt, how it works, giving a bit of an introduction.
Yeah. So venture debt is really a less dilutive form of capital that companies can use to either extend runway or use as an insurance policy, especially in between rounds, or to get to an inflection point in the business where it makes sense to raise that next round. So it's not a substitute for equity, but it usually comes in along with a round of equity. So I'll give you an example. It's a company raises a Series A round of $10 million. And the company has some product market fit, say, and is starting to scale a bit. It would be, I think, ideal. That's a classic entry point for venture debt. So you've got your $10 million raised. And what we would do, or a venture debt provider would do, is leverage that basically round of financing with between 20 and 40% as a rough rule of thumb of that round in the form of debt. So you've got 10 million. We can come in with a $3 million venture debt loan, and then you could use that 3 million for basically anything you want at any time. It usually would have a drawdown period where you can draw down the money over 18 or 24 months typically. And then whatever's outstanding after that period amortizes out like a car loan of equal payments of principal and interest over typically 4 years. In practicality, it's usually refinanced and upscaled when you raise your next round. So yes. Let's say in 18 months or something, you raise your Series B, we would take that loan from 3 million to 10 million, and we would reset the terms and reset the clock and open up the interest-only period again, and so on and so forth. So that's what venture debt is used, and it's, like I say, I think the best way to think about it for early stage is kind of as an insurance policy, kind of to use for a rainy day. Is that helpful?
Yeah, that's great. I guess just in terms of just digging a little bit deeper for a minute, what are some of the typical terms that your founders need to be thinking about when they're actually structuring a venture debt facility?
Yeah. So let me share the other way of how we underwrite these things too, and then we'll get into terms. We consider these, especially at the Series A, Series B, Series C level, as investor-dependent term loans is what a venture debt line of credit is. So when we underwrite this loan to the company, we're underwriting to the company. We're evaluating the team, the sector, the business, the projections, et cetera. But we're also underwriting to your investor syndicate. And we've had the benefit of having relationships in the venture capital community for 20 plus years with many firms. And so we built a relationship. We understand their strategies. We understand, what their follow-on their follow-on policies are like, et cetera. So we have, when we look at it, that's why it's more kind of art than science doing venture debt lending, because there's an underwriting piece that we're looking at the company, but it's really the softer piece around the investor syndicate and the dynamics around that syndicate in terms of how aggressive we can be when we underwrite a loan there. And then the terms vary. I think it's a good time. Since the banking crisis, there have been a number of new players that have sprung up. We are one of them. The core of our team came out of Silicon Valley Bank to start this practice, but there's a number of groups that have sprung up, and so it's a very competitive market. I think it's a really good time to get venture debt. I think you'd always usually shop and get a few different offers, and then figure out who the best fit is. The other nuance I'll say is there's venture debt comes in different forms. There are banks that provide venture debt, and those are usually like us, HSBC, other banks, and then there's also venture funds, debt funds that provide venture debt. And there's nuances between the two of them. In a high level, venture debt from banks usually is a little less. It's a little less costly, and it may be more restrictive, but typically is not. It's very flexible. Venture debt from funds, they can typically be a little larger, a little more aggressive, because their rates are significantly higher. And so those are the two types of groups that offer venture debt.
Okay. So going back to the point that you made there about the VCs and the investor syndicate being really important, I've heard of the venture debt arrangement almost being a tripartite agreement, and obviously you're not lending to the venture debt firm, but really kind of the point that you're trying to make there is that actually investor syndicate is an important part of your assessment of whether this particular company is a good candidate for venture debt, and whether you're going to have the continued funding momentum to be able to actually continue their growth and success, and obviously pay back that facility.
Exactly. And as I said, the repayment for us is that next round of financing.
Yeah.
So we want to make sure that if the company is unable to attract new capital from outside new investors, that the existing syndicate has the wherewithal capacity to support that company going forward, at least for a bit.
Right. Excellent. So great to bring you in, Scott, and just get your perspectives, like from a founder heading into maybe the Series A round. They're looking at their funding options. Like, what do they need to be thinking about when they're actually considering venture debt? Some of the different elements to it, how it works.
The key part is, as Jim mentioned, in the early stages, the relationship with the VCs. So usually when I'm working with the founder, we at Ativo recommend we get a term sheet right away when we close a round of funding. That gives us the option. So we don't have to sign, we don't have to execute the term sheet. We don't have to draw any of the funds, but we do want to understand what our options are and go out and run a process. And when we're running the process, we are looking at obviously the banking partnership. If we're going to talk with the banks and the banking institutions, we want to look at the flexibility and what other ways that the venture funds can structure venture debt. What is the right amount of capital? I'm looking at extending what runway for our founders. So give us money equals time. Time equals the ability to make mistakes. And no matter what happens, no matter what plan you put in place, you may get to the same spot at the end, but you're going to get there most likely in a different route. And that extra runway gives you the time to do that and get to a point where, as Jim mentioned, if you are growing the company, growing enterprise value, and your rounds continue to go up, then yes, you can refinance the debt. It's not a problem. And you're able to kind of keep leveraging the debt in the right way. If you end up with a flat round or down round, that's where you get in trouble with debt, and it becomes a question of being able to repay it. So I'm always looking at term, like how long do I have to draw the facility, and how long do I have to repay the facility? That for me is going to be the number one determination of impacting the cash runway. Rate is marginal. I think on most of your term sheets, you're going to be in a pretty tight range when it comes to the actual rate that you pay. So really, the term is I would say one of the biggest drivers what I'm looking at.
Okay. And what about other things like warrants and coverage and things like that? Are there other elements there that people need to be thinking about that you think are important, or are they less important?
Warrants are part of the equation. Not every institution will take warrants, so it just kind of depends. I'm weighing warrants against interest cost. I'm upfront facility costs, back end balloon payments. There's a lot of push and pull. So if you want no warrants, you're going to pay more cash. If you want less cash, you might have to give more warrants. So it's kind of, some of it's the appetite of the founder and the investors. For what we're trying to solve for is cash runway. So how could I, pay out as little cash as possible and give us the biggest opportunity to get the most runway, for the company.
So the scenario that you were describing there, it sounds like it's almost like if I'm doing a Series A round, you might even be encouraging me as a default to actually, if you've got the opportunity, get a venture debt facility put in place. You may not be drawing that immediately, but it gives you optionality in terms of being able to actually extend that runway should you require it. Is that kind of a summary of kind of what your position is?
Exactly. And so as Jim was mentioning with structure, so if you have a draw period, usually you're drawing your funding to get ideally 20 at this point in time 24 months of runway.
Yes.
The longer you have to make a decision whether you have to draw the debt facility, that usually gives you the extra time to less cash you're paying down on it, and therefore more cash that you get to extend the runway. Yeah. We want to at least get a minimum of a quarter extra runway, and as much as possible. I don't know, Jim, it'd be interesting to see how you're thinking about structuring. Do you look at, when you're kind of underwriting the deal, are you looking at the amount of runway? If you're looking at the company's plan and you're layering in the debt facility, are you looking at the runway that you're providing, or is that more from my lens?
Yeah, I mean, we definitely are. From our underwriting perspective, we want the company to have at least 15, 18 months of runway without our debt. And then we look into, what's this incremental piece if we put on a piece of venture debt? How much does that extend? And yeah, I think, as you were saying, Scott, trying to get at least a quarter of additional runway through the line of credit is helpful.
Yeah, usually a quarter gives, if things are slowed down a little bit, or you need to, make a slight pivot, a quarter gives you enough time to kind of see the results and therefore keep the company moving in the right direction into the next fundraising opportunity.
Right. And thinking about moving through the different funding stages, how many, we're talking mainly about Series A so far, how many startups are in a position where they might even be able to actually take on venture debt earlier, maybe even in a seed round? And then does that actually change then as you go through a Series A, Series B, and then beyond? How should founders be thinking about that as they go through those phases?
So going through the stages, if you go a seed round, and I'm going to say traditional seed round. So a traditional seed round means I have no revenue. I may not have a product yet. I have an idea. I want to build it. Obviously, today seed rounds are a little different. They're not all like this, but let's say the traditional sense. The debt providers are really looking at relationships. If you have high quality backers, VCs, if it's not their first time founding and they've had successful exits, you'll have access to a debt facility of some sort at a seed round stage. If you don't have top VCs and this is your first time doing a startup, at a seed round it could be challenging. Even if you raise, I would say you need to raise a pretty sizable round because they're not going to offer you on the range that Jim said 20 to 40% of your raise. If they really are going to be looking to establish a relationship with you, they may not go to that length. They may only give you 10% of your raise just because they don't know the investors and they don't know you. So that's where you're at on the early stage, and you're going to look at a traditional what we call growth capital line of credit. So it's a blank check with a payment schedule. It's not tied to usually not tied to any type of revenue because you don't have it yet, and there might be some draw restrictions on your product development cycle. So if you're saying I'm going to get to an MVP in the next 12 months, maybe that unlocks another tranche of the facility. But it's going to be a pretty simple, not too many options there. As you go into Series A and B, and Jim, I'll let you jump in a second. Obviously, the line sizes get bigger, and now you start to have financial performance in the company. You might have gone to market. You might have a sizable ARR. You might have customers, contracts. So then the debt providers can get a little more creative. They'll get more creative on how they tie, upsize the line facility. And for instance, they'll look at ARR. As you grow ARR, the line will grow with you. The other side of it is, now that they have metrics to really judge you by, covenants might come into play where they say, okay, if your metrics start to weaken, that will do the opposite to the line. We might slow down the availability of the line, or get into a situation where they have to have a conversation of how is this line going to get repaid given where things are going. But we don't want to think you have to model that and you have to understand that. But obviously, we're hoping that things continue to grow.
Yeah. Maybe if I can just comment a couple things, because you said some good things there, Scott. One thing is, we oftentimes will tranche these deals. And a tranche is, which I'm sure Scott will fight against having a tranche. He wants all availability for his client all at once, which I get. But we also want to mitigate risk and give the company the right amount of debt at the right time. So we may offer a $5 million line, but we'll say we're going to have $2.5 million available immediately, and the other $2.5 are going to be tied to some KPI in the business, and that, whether that's a revenue milestone, a customer milestone, a partnership milestone, something that is a value creation event with the business that gets us comfortable with the risk profile. That's one thing that we'll often do. The other thing is, as companies scale, as Scott said, we can get a little more creative and more with the structure, more flexible. We go from less being investor dependent to more company dependent, as there's real revenue and scale in the business. So a Series C, D company, the investors are important, but we're really underwriting the company at that point. And we can do and that usually drives down the cost a bit and gives you some additional availability and flexibility in the line that is warranted for a company of that scale versus being at seed or Series A. So those are just a couple nuances.
Yeah, that makes sense. So one point I just want to come back to, we spoke about, Scott, you spoke about post a funding round, you advise the founders to actually have a venture debt facility put in place. How do you then think about the utilization of that as you actually go through, between rounds? And given the non-dilutive element of venture debt, are you recommending that you absolutely make sure they utilize that before they raise their next funding round? How should founders be thinking about that? And I'm sure it depends on their individual circumstances, but if you've got an overview of kind of how founders might think about that.
In general, we don't want to pull the debt unless we need to use it. So adding runway, or adding cash on the balance sheet just for the sake of adding cash on the balance sheet is not the right way to think about using this facility. It's one, if I need to buy some time, so I need an extra quarter. Our product launch was delayed. The V2, V3 of the product is key for our next fundraise round. I need a little extra time to get there. I'm trying to win a big contract that's going to change the whole dynamic of the company. It's taking a little longer to work through that contract, so I need to bridge that gap. Sometimes you do think about the strength of the balance sheet. So going in at annual reporting periods, if you have showing a little more strength of cash on the balance sheet going into a fundraise, so the fundraise might take longer. So we're seeing typical time to get a fundraise done is 6 months. You should already have started that process and give yourself 6 months to close the next round on average. So
is that different across? Sorry, is that different across the different funding stages, or is that just sort of in general what you're seeing seed through to probably Series B?
So earlier stage, it's relationships. You've got a strong relationship. They know you. You've got a great idea. It's a much quicker process. Yeah. Later stages, I would say it's a longer process. Later stages, just because you have so much information in the company that now people want to dig into. So the investors have more to look at. So it takes a little longer process. It depends also how active the founder is with investors. So if they're really, a founder should always be fundraising. So if you're not periodically checking in with potential investors and you start the process from zero, then yes, it takes a little longer runway. That's usually, what kind of is some of the gating items when it comes to the fundraising process. Also, again, timing with your milestones. So if you're about to hit 10 million ARR and you can't quite show it yet, that milestone's a big milestone for a lot of folks.
Yeah.
So,
Yeah.
Give you that extra month or two to land those extra revenue to hit that milestone, and then go out a lot stronger as you're fundraising. So there's business dynamics, there's relationship dynamics, and there's the amount of information that you've got to get ready and prepare for a fundraise.
Great. Jim, any thoughts on that?
No, I think you hit it on right on. I mean, the dirty little secret of venture debt, which it's kind of the dance that is played, is we don't want to be last money in as a lender, right? Scott wants to, he wants us to have a maximum availability and to use it when you really need it, which we understand. We also want you to be able to use it when you need it, but we also don't want the company heading down a rabbit hole and we're the last money in and there's no funding around, and that's when we get into trouble. So that's where using it becomes really important, and having an advisor like a Scott around to help advise you on when to use and how to use it and how much to use is important, because it's important. It is debt. This is not equity. This is a complement to equity. I think some founders think, oh yeah, if I can get raise 10 million and put 5 million of venture debt on, that's 15 million I can use right off the bat, and I'll spend to that plan and we'll off to the races. Not quite. So that's where just really being clear on what the use is for is important.
So can we spend?
And Jimmy, Jimmy, make a great point, because I'll backtrack a little bit. Like, I was talking from the sense of, we're not going to pull it till the very end when we need it, and that will be frowned upon for sure, and that might not be an easy way to pull the funds. So, if to be very strategic with debt, and if we know that, hey, we're really going to use the debt and we think we're going to utilize it, it's not about waiting till the last minute to grab it. It's about, just as you tranche it for availability, I'm going to tranche the draws onto the balance sheet as well. So I want to show that, one, hey, we put in place, we're working with the banks, we put in a place that works. I'm helping, the bank with deploying their capital by taking it to the company, and I'm helping the company by making sure that we have availability on the line, that we're not overspending on it. So I don't want to draw it. It'd be really hard for me to draw a full line day one, just because if I truly don't need it, I'm spending all this extra interest, which, it's not fair to the company. It might be fair to the bank, but it's not fair to the company. So I got to balance the interests of both the company and the bank. If I wait all the way to the end and I've got less than 3 months runway and I haven't started a funding process, Jim may not release that. Jim may not transfer the funds into the account. That's where, when we talk about the relationships with the VCs, that's where that becomes critically important, because the bank is from a company perspective, we're performing, but from a cash perspective, we're burning, right? We're burning hot, and we're going to be out of money shortly. So that's where those relationships with the VCs, that's where having these conversations, the founders need to know that the banks are going to want to know our VCs. The process I just ran the process with a company, and I have plenty of banks I could reach out to. I defer to the VCs. I say, hey, who are the folks you like to work with? Let's go talk to them. And then I'll say, hey, I have these other folks. Should we throw them into the process? What was interesting in this last process that I ran, one of the VCs, we started the process with 4 banks. One of the VCs came back and said, look, I want you to pull this bank into the process. And after and they came a little late to the party, but they came on strong. And because of, and then there's some intangibles we could talk about as well, because of some of the intangibles in the relationship and the way the bank approached the relationship with the founder, that bank actually ended up winning, getting the term sheet across. When I would say before they entered the fray, I wasn't even considering them or thinking they would be considered. So it's there's more than just the economics involved, and especially at an earlier stage, those intangibles are a lot more critical for an early stage company than say later stage, because later stage, again, there's the business is operating, running itself. It's got its own two legs it can go. As a startup, every partner you bring to the table is valuable to help advocate for the founders and the product and what we're doing.
Yeah, that's great. And I just want to go back. We've talked about a scenario where we go out, we go on and we're raising the next round, and where the company's growing quite successfully. What in the scenario where that doesn't happen, there's down rounds, things don't go as expected, or maybe even raised in 2021 when valuations are very high, and so companies still trying to grow, some of them growing into them. So what does that scenario look like? How do founders need to be thinking about that? Maybe Jim, if you could.
Yeah, the downside scenario, I mean, it's easy to lend when things are up and to the right, and it's easy, that's all great. It's really, where the metal hits the road is when when you have some tough times. And most companies don't go up and to the right? There's always some bumps. So we are, you want to work as a founder with a lender who is a patient lender, who understands how startups work, who isn't unreasonable, isn't going to set off against your cash accounts, which I think you legally have the right to do in these loan documents. But if you start doing that, you're not going to have a very good reputation in the industry. So this becomes then a really collaborative workout situation where we come up with a plan. Maybe we reset the terms a bit to take a little pressure off the company, to get to a monthly payment amount that they're comfortable with. We defer some interest. So there's lots of things we can do to get through a difficult situation, but that's where the partner matters. And so. Yeah, those we've been through many of those. Those are really, to be honest, I think about the best relationships I've had in the venture community. It's going through those tough deals with VCs who are in the boat with us and are all rowing in the same direction, knowing that this thing's going to be a fight and it's going to be tough, but working together to help is where some of our great success has happened, actually.
Yeah, and this is fortunately, unfortunately, I've had to work through these situations as well, and it requires having a very responsive VC on the cap table, someone who has a good relationship with the bank, or at least has developed a good relationship with the bank, and really they have to show that they are still behind the founder, still behind the company and the product. And I would say in many times there needs to be some sort of consideration coming from the VCs to kind of make this work a little easier. So, call it a bridge loan, convertible note that would come in versus a full round that would kind of help give some comfort to the venture debtor that hey, there is a little capital there to help repay the debt, and really putting in a good solid plan of like, here's how we move the company forward. These are the near-term milestones. Here's how we're going to achieve them with the extra runway, and then showing that that's going to be increase the enterprise value so that we can go get a successful round.
Yeah, I'm just hearing again and again just how important that tripartite relationship is between the venture firm, the bank, and also the startup, and making sure that from a founder's perspective, I'm really not just thinking about the hottest deal terms. I'm thinking about who are the people that I've got working with. If things aren't all up and to the right, then actually making sure that I've got people that are actually going to work with me in a really pragmatic and supportive way through that process. Just switching a little bit, I'd love to just explore, we're in really interesting times at the moment in terms of where the market is, and I hear people talking about haves and have-nots, and some of the things we're seeing with funding data at the moment. You're seeing some absolute supersized funding rounds, even really early on at seed stage for some companies that the revenue growth rates are phenomenal and things that we've never seen before. I'd love to kind of explore a little bit about how that's playing out in the venture debt space, what you're seeing, and maybe Jim, I could actually throw to you to give a few perspectives on it.
Yeah, we spend a lot of time with this because there is really, there's AI and there's everything else.
Yes.
But within AI, there's you've got to really dig in to see, is this a native AI company? Is this something novel, interesting? Is the revenue real, et cetera? Versus, is this a legacy company that has spun up an AI strategy and story where it's truly not, leveraging the LLM and AI capabilities like they should be. Most of the oxygen in the venture community, and hence most of what we're seeing, is AI related, right? Those companies that have these super high growth rates, that are scaling, that have raised large rounds, obviously those are the sexiest companies to work with, and everybody wants to work with those companies. I think if you're not a native AI company, or you don't have an AI story, and you're not growing super fast, your next round of funding could be tough. I mean, that's just the reality of the market today. Now, there's lots of funding sources. I don't want to say it's that drastic, but we've had a number of scenarios where we have good companies that have had steady growth of revenue that have been around for a while that are still burning money, and they can't raise money. It's they cannot get the attention of a new investor because that investor is focused so much on the newest, highest growth, sexiest opportunity that they can't, So it's really an interesting dynamic. It's some of the scale, this revenue scale numbers that I've never seen in my career, of companies going from 0 to 10 to 100 to 250, whatever it is. It's unbelievable. I mean, it's mind-boggling. But and all things will cycle. What we know about this business is that, having been in it as long as Scott and I have been in it, is that what goes up comes down, and everything is cyclical. So, this AI run, this is transformative. This is incredible. There's going to be a ton of value created here, but there's also going to be a lot of failures, and a lot of companies that are just going to run out of money and have probably spent too fast. And so it's a really interesting time to be. You got to be really careful.
So, and also what's unprecedented, as you're saying, Jim, the revenue growth, the rate, and the amount of revenue growth in such a short period of time. So the triple, double, getting to 100 million in 7 years, that playbook has been around my entire career, and it's right. Pretty much torn up when it comes to right. AI. It's still an amazing outcome, right? But it's not. It's being dwarfed. The other side of it is the amount of capital being raised pre-revenue, pre-product launch, just because of AI. That's been mind-blowing as well. We're talking, 100 million seed rounds, and there's nothing to show for it yet. So it's interesting. Obviously, I have not had to go out and raise debt for that type of a company, even though theoretically, they are scaling up that much because of the capital cost. How many deals are you seeing for these mega rounds, and then also looking at debt at the same time?
It's not as much at all, Scott. What we want to do is position ourselves as the banker. We want to bank that company, right? Because every company needs a bank. And so we want to be a bank for these companies, and we've got many of them as clients, and start the relationship. And then let's, when if debt makes sense at some point, then we've got the relationship, and it becomes much easier as an incumbent. But yeah, I think a lot of those companies aren't thinking about debt, nor need it or want it.
Right. Just wrapping up on the venture debt side, I'd love to get a couple of two or three of your top tips, and when founders are actually thinking about venture debt. So Jim, love to hear from you first.
I think it's a couple quick ones. Is as we talked about, raise it when you don't need it, right? Banks and others love to lend money when you don't need it. You have plenty of cash, but that's when you want to raise and get your line in place. As Scott said, shortly after your fundraise is the best time to do it. I had a really good friend who's an amazing seed investor who says, yeah, Jim, he loves putting venture debt on his companies, but he says, I want to work with the company for 6 months and work with the founder to make sure they understand, just to see them grow as a founder and CEO, and establish that relationship before I want to introduce him to you for a potential debt line. Interesting. I think that's sage advice of like, just be, debt is a great option, but it's not for everybody. And just know that it's debt and it needs to be repaid. It's a wonderful complement to your balance sheet. But it is debt and it's not equity. And so just go in it with both eyes open. And again, with that partnership mentality, I think it definitely works.
Great advice. Scott?
Yeah, I echo everything Jim said there. I think what's interesting, sometimes debt is brought up and it can be very polarizing. Some folks are saying, don't ever go near debt. Don't touch it. It's bad. Inherently, again, do understand the situation you're in. Is debt actually appropriate or not? If you take, when you take debt, we, again, at Ativo, we're working with early stage founders. We say, look, raise the round, get term sheets. You don't even have to execute the term sheets. Just understand what the options are. Bring it to the board, let the board review, let them approve it, and then we can put a plan in place to use it. Debt has to be repaid. So when the company runs into a tough situation and they're not going up and to the right and they're going down, that does become a challenge. So debt in itself is not the issue. It's putting together a solid plan that makes sense, putting in solid milestones and metrics that make sense for the business and achieving them. If a company puts together an honest plan in front of a debt provider and everyone around the table says, hey, if we can stick to this plan, this will work, then generally this will all supports what debt you're raising, and you've got folks that will support the company. Again, barring complete macroeconomic issues, but again, if you're performing, it's good. When a company puts together a plan that is too aggressive and they can't reach it, it's not executing on the plan, which the bank is underwriting and which the investors are underwriting. That's the issue. It's not the debt itself. Of course, the debt becomes a challenge because a new investor doesn't want to pay down debt for the company. They want to put in new, fresh capital to grow the company, not pay for what the company's already spent. And that's where that's where the challenge is when you're not meeting your plan and you're not growing according to what the market's looking for.
Right. Thanks for that, and thanks for sharing your all your insights around venture debt funding and I guess where the market is at the moment today. Just to wrap it up, maybe Scott, I'd love to hear a little bit more about when should founders be reaching out to you? How do they find you? What if you can just give me a quick rundown.
Yeah, you can definitely reach out to me at my email, SMOLLOT@Ativo Partners, ATTIVO partners.com. And you can catch us on the website. Also, you can find me on LinkedIn. We love to work with founders as early stage as possible. The sooner that you think about your accounting and finance infrastructure and start putting the pieces in place to do your forecasting, preparing for fundraising, much easier it'll be for you to go out and get the capital and focus on your business rather than all of the back end pieces that need to be put together.
Right. And Jim?
Yeah, it's jim.marshall with 2 L's at us.hsbc.com. And I'm also on all the social channels, LinkedIn.
We'll also have the details in the pod as well, but yeah.
Yeah. And similar to Scott, we want to work with companies from pre-seed and be your bank, start the relationship. We typically entered venture debt at Series A. We've done some seed, but it's typically from a debt perspective at Series A, and then we can help you grow and scale, not only domestically, but we're in 60 markets across the world, so we can help you grow without a lot of friction. So,
Great.
Thanks so much.
Thanks very much for your time, gentlemen. I really appreciate it. As you know, we help founders streamline cap table management and build great teams with equity incentives. And one of the things that's really important to us is making sure that founders have the right information so they can make informed decisions. But equally important, make sure they've got the right team around them. And it's been a real pleasure to have you on here, Jim. HSBC doing amazing things in the innovation banking space, not only in the US, but I'm seeing it right around the globe. And Scott Ativo, having someone with the depth and breadth of your experience and the broader team, again, great people to have in your corner as a founder as you're going through that startup journey. So thanks very much. I appreciate your time, gentlemen, and I look forward to connecting again soon.
Yeah, thank you, Cal.
Thanks very much.